Hello traders, you're welcome back to the Forex Geek channel. In this video, we are diving into a powerful pivot point scalping strategy. It's a clean and structured way to scalp the markets using nothing but pivot points and simple price action. This is especially useful if you are into fast-paced intraday setups and want to catch solid moves without getting caught in market noise. Okay, so let us start with what pivot points actually are. Pivot points are calculated levels based on the previous day's price action. All right, specifically the high, low, and close. All right. So they create key levels like the central pivot point, support levels, and resistance levels. These levels act as dynamic zones where price tends to react, either reversing or breaking through. The core of this strategy is waiting for price to approach either the central pivot point or the first support or resistance zones. Okay, we want to see how price reacts. Does it stall from a weak or reject sharply? That's our clue. All right, so once we see that reaction, we look for confirmation, either a bullish engulfing candle near the first support or a bearish engulfing at the first resistance, for example. Okay, so that is our entry. We take the trade in the direction of the bounce or rejection and target quick moves, usually back to the pivot or the next level. Now, which time frames does this work best on? All right, you can actually decide to use the 1 minute or the 5-minute charts. Okay, remember that you are scalping, right? Because these charts give you enough detail to enter with precision while also respecting the pivot levels derived from the higher time frame, usually the daily pivots. Now let's just go through an example. I'm just going to add pivot points. All right, so this is just an indicator that I added for pivot points. All right, okay, so we can see that we have resistance 1, resistance 2, resistance 3. We have support 1, support 2, support 3. Okay, so imagine the market opens and quickly drops to support 1, that is S1. Price touches S1, maybe forms a double bottom, and we see a strong bullish candle close above the previous week. This is just an example. All right, it's an assumption. Okay, we are trying to paint a picture. Okay, so imagine that such a scenario happens. All right, but let's see if we can get something close at least. All right, I think we have something close. So just imagine the market opens and quickly drops to S1. Price touches S1, forms a double bottom, and we see a strong bullish candle close above the previous week. That's our entry signal, right? That's going to be an entry signal. Stop loss goes just below the support zone. Okay, let's just see, this was where the S1 was. So your stop loss is going to be going below the support zone, and your take profit is set at the pivot point or halfway to the first resistance, halfway to R1, right? Halfway to R1. Okay, but ensure that you have good risk to reward ratio. If you do not have good risk to reward ratio, you can just stay out of the trade. All right. So it's clean, fast, and based on reaction, not prediction. This method works well in high volume sessions like London Open or New York Open, when volatility ensures that we actually reach those pivot levels and see reactions. Avoid using this in low volume or ranging conditions, okay? To manage risk, always use stop losses. Stop losses are very important. Just because pivot points are strong zones doesn't mean they are invincible, all right? If price slices through a level without hesitation, don't fight it. Just wait for the next setup, okay? Do not try to chase a trade. Do not try to chase, chase moves, all right? If price action has gone ahead of you, just look for another opportunity, all right? If you missed the train, just wait for the next one. And one more tip, keep your charts clean. You don't need 10 indicators. Pivot levels, a basic candlestick pattern, and a solid risk management rule is all you need to make this strategy effective, all right? And make sure that you do not trade with an amount that you cannot afford to lose. Also ensure that you observe good risk to reward ratios. Just like I pointed out, if you get a good opportunity after market opens, maybe you get a rejection around S1 or even S2, and perhaps you get a confirmation from candlestick, and it happens that your stop loss level, which ideally should be below swing lows for a buy or above swing highs for a sell, you notice that if you set your stop loss and you want to set your take profit, your take profit levels, which ideally should be around key resistance zones for a buy or around key support zones for a sell, you notice that it's not giving you a good risk to reward. Like what we can see happening here, it's not giving us a good risk to reward, okay? Unless if you want to have a tight stop. But if you are setting it below this, we have a bad risk to reward. But if you're having a tight stop, you have a good risk to reward. So basically, just make sure that your risk to reward ratio is at least 1:2. All right. If it is not up to 1:2, then you can just stay out of the trade. But if it is up to 1:2 and your profit target is realistic, maybe around the first resistance or around your pivot point or close to your first resistance, then you are good to go. Okay. If you found this video helpful, hit that like button, subscribe to the channel, and turn on the bell icon so you don't miss the next strategy breakdown. Drop a comment below if you want me to cover a pivot point strategy for swing trading next. Catch you in the next one. Happy trading.